Welcome to Policy Bazaar. I'm Arjun Bhagat. Now, in our last episode, we discussed 4 of the 7 types of insurance policies that you must have. Today, we'll discuss the remaining 3, and these include child plans, pension plans and asset insurance plans. Now to give his valuable insights and also to do a short recap of the previous episode, we have Yashish Dhaya with us, CEO of Policy Bazaar, also its founder. Welcome to the show, Yashish. You know, last week we talked about 4 types of insurance that one must have in one's umbrella, and basically that was we looked at term insurance plans, we looked at health, and we looked at personal accidents. Of course, not in that order. Can you give us a recap on why these 7 types that we are looking at are important and the 4 that we've already covered?
Any individual, most individuals should be worried about the financial implication of certain events. Those events are death, which is a term plan, disability or accidental death, which is a personal accident plan, critical illness, those big diseases which we hope never come to anybody, but the reality is they do come, and India is pretty much the capital of those diseases. Heart, brain, lung, tumor, cancer, those are critical illnesses. Health insurance, we all know what health insurance is, or at least most of us think we know what health insurance is. I think the 5th thing, there was a recent survey and it was found that 79% of people are very worried about pensions. Anybody who doesn't have a government job and a government pension should be very worried about, specifically given inflation, what their pension situation is going to be. 6th thing people should be worried about, and mostly are worried about, is when their children grow up, how will they be settled? How will they be educated? What will be the additional costs that will come at that time? Whether it be a settlement in business, whether it be a settlement in a job, whether it be a marriage, and marriage on both sides, both girl and boy. Today to start a new life, people need certain costs, and all of this does matter. And I think eventually you do come down to, okay, if you have a car, if you have a house, how do you insure those? But we spend a lot more time worrying about the last part than about the first 6. And I think just to recap, it would be in that order: term insurance, personal accident, critical illness, health, pension, child plans, and finally any assets that you have, let's insure those as well.
You've talked about the 4 that are critical, and then of course the 3 that we really need to discuss. One is retirement planning. You talked about that. How does one prepare for post-working, the post-working stage of one's life? Children, and you talked about assets. So let's go systematically. Let's talk about retirement. And when should retirement planning actually start?
Sure. I think usually when we look into the future, things tend to become futuristic, and people can dismiss them. But it makes a lot of sense to look in the past. So I'll go back to my grandfather, who's today 93, and he retired in 1977 from the army. His salary in 1977 as a colonel in the Indian Army was about 700 rupees, and at that time 700 rupees was considered decent. My father, who retired in 1990, his last salary was about 5,000–6,000 rupees. He also retired as the colonel. And it was good. Today it is not. So imagine my grandfather, who retired in 1977, and since then, what? About 40 years? We're getting to maybe 37 years. 37 years have passed since his retirement. So what have costs become? 700 rupees was his monthly salary. He had 4 daughters. He was taking care of them, and he felt comfortable. Today, 700 rupees, probably 70,000 rupees is the equivalent of 700 rupees.
Won't even fill your gas tank.
But 70,000 rupees, in my view, is the equivalent of that. So my brother is also a colonel in the Indian Army right now. He gets more than 70,000 rupees, right? My first cousin. So all I'm saying is, that is how costs have moved in 37 years. Will they be the same in the future? We don't know. I can say yes. Somebody can say no. But the thing is, it's worth worrying about. Inflation is something that one needs to worry about. Because what I just said, in 37 years, costs have gone and salaries have gone 100x.
So what you're basically saying is that the value of the rupee is falling. What you're earning right now will not buy you much in the future. So you really need to invest accordingly.
Fact is, this 100x every 35 years is happening. And today, a person who's 30 is staring at that when they are 65. So not planning for retirement is not an option unless one totally believes they're not going to live beyond 65 or 60. Most of us believe we're going to live longer. We're going to live a healthy life. The investments that have happened in medical care and the investments we're making in our own health imply we're going to live longer. So pension is something we need to be worried about. And rightly so. There was a recent survey which said 79% of people in this country are very worried about pensions. A systematic investment in pensions can go a long way towards bridging that gap. But the earlier it starts, the better it is. There is a lot of work that has been put into the public domain by me and by others, which says a 10-year head start in starting your investment implies you have to invest only half the amount. So if you start at 28 and you invest 10,000 rupees a month, if you start at 38, you need to necessarily invest at least 20,000 rupees, maybe a little more, maybe about 25,000 rupees.
So basically what you're talking about is the magic of compounding and setting aside a certain in your nest.
Yes.
So that keeps growing. You're not taking that amount out.
Absolutely. Absolutely. Now we come to the point of which product is good for pension planning. And unfortunately, we don't have too many of them. As a country, we don't have too many of them. Today, in my view, the low-cost unit-linked investment plans, the low-cost ULIPs, stand out as one of the best options over a long term. And I'll again come to why. Okay, so let's look at any investment. In an investment, three things happen. You invest money, you make some returns on it, and finally you withdraw that money. Insurance and provident funds are the only two instruments today. I don't know what happens in the future, and there are a lot of experts that say that things will change in the future. But as of today, these are the only two instruments that are exempt from tax on all 3 points. So you get a tax break when you invest. The money you make on returns is tax-free. And when you withdraw the money, it is tax-free. That is not the case in any other instrument. So if you're looking at mutual funds, when you invest, the money is not tax-free. Even if they are equity-linked mutual funds, when you invest, you don't get a tax break. If you're looking at pension plans, most of the NPS and other pension plans, even the insurance pension plans, they do not have a tax break at the end. A low-cost unit-linked plan becomes the best instrument because it gives you the market return, it gives you the tax benefit for a cost which is very, very abysmally different from a mutual fund or from any other form of stock market investment. So,
but the key here is that you have to look at it from a long-term perspective.
You cannot break the plan in the middle.
Precisely.
That's not the idea.
Yeah.
Because you're going in for a pension plan.
Because we want to stress that. Because a lot of people go in and they panic when they've invested in ULIPs, or they start panicking.
You should not look at the NAV.
Precisely. So what you're saying is look at it from a 15, 20, 30 year.
You got to look at it from a 15, 20 year plan and you will do quite well. Look at history. History will give you the data to prove that the future is quite bright in that respect. And one needs to be careful because over a long period, these things can be...
And NPS hasn't really kicked off to the extent that it should have by now.
See, I'm not going to just follow and say NPS is a great product. NPS has a low cost of operation. But from a tax angle, it's not the best because your returns will be taxed. When you get the money back, they will be taxed. Second most important thing is the flexibility is so low in the NPS now. And when you have very low costs, you also can have, fund allocation problems. So I'm not a great believer. Plus the exit, when you exit from an NPS, you've got to invest a lot of that money back into certain plans, annuity plans, which may not be most suited for the consumer. So I would say low-cost ULIPs still stay the most transparent product, still stay the most low-cost product and the reason nobody's going to come and sell those to you is again because low-cost ULIPs have got very low commissions. Nobody's interested in pushing it to you. So thank you very much. The distribution is not going to help you.
Right. So we've looked at retirement plans, and yes. Let's look at child plans and the planning that goes in, supporting one's child as he or she gets older.
Sure. So again,
and cost of education, of course.
Let's again go back into history, because I believe history puts the context very clear and people understand it very clearly. So I went to INSEAD so I went to IIM Ahmedabad in I think it was 94. The cost of education at that time was about 30,000 rupees per year. Today I'm told it is about 14-15 lakh rupees. So it's become very expensive. Went to INSEAD, which was about 9.5 lakh rupees. 6 years later, my wife went to INSEAD. The cost was 30 lakh rupees. Today I'm told it's over 55 lakh rupees. The point I'm making is cost of education is growing much faster than inflation. So we need to plan for it again, because if parents are keen on providing that education to the kids, then they need to plan for it. Otherwise, it will cause financial havoc at the point when the event happens, because if it's not planned for, right? Now, there are a lot of people who would say, why don't you go for a term plan and a mutual fund investment, etc. See, insurance is about protection. Insurance is about protecting from unfortunate events. If an unfortunate event was to happen, and one was to get paid by a term plan, their family was to get paid with a term plan, the child is still 6 years old. What is the guarantee this money is going to be available when the child turns 18? How do you make sure that when the child is 20, 22, that money is available? That's exactly what a child plan does. The child plan protects that money. So whatever dream, whatever corpus one has set aside, whether it's 20 lakh rupees or 10 lakh rupees or 5 lakh rupees or whatever that corpus is, over a 20-year period, if any unfortunate event happens, that corpus is protected, and that corpus will not be made available in the middle, it will be made available at the end of the plan only. So these are plans that are very helpful to families, especially obviously for young families, and even grandparents can make investments for their grandchildren or whoever. I think it's a great way to protect the funds for the children and make sure it is available for purpose. So, monthly savings can take one down that road where that investment is protected.
So, right, we're talking about comprehensive insurance covers. We've covered a lot of them. We haven't talked about asset insurance, Yashish. What does that include, and how should one plan on taking those different types of insurance?
Okay, so far we've spoken about people and people's loss of income, people's pension planning, people's child planning, etc. Now, assets are those things that we own. So people own a car, people own a house, people own a watch, people own... Now, what happens if those things get damaged? And that is what asset insurance is for. So if you've got a car, thankfully the government has made it compulsory, so you've got to get at least third-party insurance, because those assets, specifically in the case of a car, can also cause damage to others. So third party is mandatory, but most people take a car insurance because they also see very easily that people get hurt in these cars. These cars do have accidents, and you see all those mangled cars sometimes on the road. What one has to also remember is that there may have been people in those, and those may have had personal accident issues. So I think cars are taken care of. Home insurance is the second one. So again, just because it's not government, mandatorily, government doesn't ask you to mandatorily take home insurance. Most people don't take home insurance. But the point is, what is more valuable, your home or your car? So you're getting your car insured, but you're not getting your home insured. Home insurance is not just for the structure. So of course, you may never have floods in Delhi. You may never have earthquakes in Delhi, or you may believe so, right? Or in Bombay or whatever. But if they do happen, then a structure, if it goes, it's the individual's cost, and that needs to be protected by the home insurance. But more importantly, even things within the house. So whether it's your television, we're also worried about theft. People put big, bars of steel to protect against theft. People put alarms. If a theft happens, it can be protected through home insurance, through contents insurance. You have to declare what contents you have and sleep peacefully. If the thief comes, they come. You obviously make your attempts to kind of protect your assets, but if a thief comes, it's the police that has to handle the thief. You don't have to cry about the things that get stolen, because the things that get stolen will be covered by insurance. And that's how one should live peacefully. Just like when you're driving your car, if somebody comes and hits your car, or when it is parked, if somebody comes and hits it, that's covered by insurance. So similarly, can be for your contents, and I think people should think about that. And then the contents thing can just keep going. So I think the other pieces of insurance, those are the two primary assets people have. the home and the car. So in the Scandinavian countries, people have on average about 9 insurance policies. Obviously, mobile phones are insured, and trust me, in India also we get mobile phones insured. We get sometimes our watches insured. We get expensive things insured, but again, the house contents are not insured by most people. Not even 1% of people insure their house contents. So just taking a view on that.
Is it a procedure which is difficult? I mean, is it difficult to get your house insured?
No, it's very simple. It'll take about 15 to 20 minutes of somebody's time if they went online. Lots of options. They can just pay, have the policy. End of story. Again, the thing is, these are low-cost policies, so these are not like 20,000, 50,000. These are low-cost policies, 2,000, 3,000 rupees, 1,500 rupees. So again, nobody's going to come and sell them to you. And imagine going to somebody, convincing them. You know, it's going to be a difficult task.
But they're offered by most insurance.
Most insurance companies have them. Most general insurance companies have a home insurance, and people should definitely opt for those. But they don't. So you know.
Okay. About motor insurance. A lot of people take it. It's pretty much compulsory. It is compulsory. Talk about it, because there's so many different kinds of motor insurance. Zero depreciation has come in. There's so many different kinds.
There are add-ons. There are add-ons out there. So basically, the base cover of a motor insurance policy is, if there's an accident, the depreciated amount, what's the market value, will be given to the individual, which is called the IDV, right? However, people can take zero depreciation plans. Now, what zero depreciation means is, while the depreciated value of your car might be 4 lakhs, when you bought it for 7 lakhs. So you can say zero depreciation, and you essentially, if any damage happens, you get the 7 lakhs back. Or if an accident happens and the parts that need to be changed are 1 lakh rupees, you don't get 4 divided by 7 into 1 lakh, which is roughly about 55,000 rupees. You get the entire 1 lakh rupees. No questions asked. That's what zero depreciation would be. However, salvage value will still be there. So please don't, I get this complaint from customers many times that you said nothing will be deducted. Salvage is the remaining parts which the insurance company expects you to be the salvage dealer and sell it. Usually you can sell it to the same person who's repairing your car, but that is something the insurance company wants you to take, and that's something that's usually be about 10% of the
But
cost.
Interestingly, at the workshop, they won't tell you that you can take these parts away.
The parts are usually worth about 10-15%, and you should negotiate, and that's what the insurance company doesn't want you to not negotiate.
Give it to your local kabadi wala.
Yeah, so the insurance company wants you to sell those and make money out of that. That's why they give you about 10% less than normal. So I think you've got things like no claims bonus. So we all know that, you know, we collect no claims bonuses over years. Sometimes they can go down to 50% discounts. You can protect those. You can protect those by taking a no claim bonus protection. So there are lots of these smart ones. You can have 24/7 assistance, which implies that if your car stalls somewhere on a highway, you can lock your car and sit inside and just call the emergency help, and they would come, rather than relying on the local person who might fleece you, who might create other problems. I don't know what all happens, right? Or let's say leave it to imagination. But here is an organization that will come, provide the assistance, especially for women drivers. I think it's, why women? For everybody, including myself. You know, it's quite helpful to have that support rather than kind of be stuck on a highway looking for help, you know, in the middle of the night. So yeah, those are the kind of things that are important. You know,
so before we wrap up, just give a quick take on these 4 insurance plans that you feel are absolutely critical for everyone to take, and most of the people are not really taking them.
I think 6. I think this rule of 6. The first is death cover,
which is term.
Second is personal accident cover, which is any accident. We spoke about 60% of accidents happening between the age of 25 to 40. So personal accident cover in that age group is very important. Critical illness, all those diseases, heart, brain, tumor, cancer, kidneys. Critical illness cover is critical, so please get it. Fourth is health insurance, which I think all of us are fairly aware of, but many don't take it still. Pension planning, we are all worried, but we don't execute on our plans or our worries. And the 6th is child cost planning, or, you know, planning for when the children grow up, how will they settle, how will they be educated. I think these 6 are a must. Once you've completed these 6 and in that order, then please go and do whatever else in terms of insurance. But, you know, these 6 one must take, please.
Thanks, Yashish. That's all the time that we have on this episode of Policy Bazaar. But do write to us at ask.policybazaar.com or tweet us at policybazaar_in. And we'll see you next time. Goodbye. Bye-bye.